Here and now, what's been happening in the last couple of days with yields, U.S. yields especially, right? The 10 is at one stage hit 435. The long bond, as we were talking a few seconds ago before air, nearly went back up, nearly hit 5% again. Was this just all Greenland, or was this, how much of this was actually sparked by what's going on in Japan and the way their long yields have gone literally nuts? It's been a, 5-6 standard deviation move. It's been incredible.
Well, I think there's a few factors here. Firstly, the US economy is doing very well, as we saw in the economic data yesterday. And the fact that the US economy is doing very well, I think that's putting a question as to whether the Fed really needs to be talking about cutting interest rates at this juncture in time. Certainly, we don't expect anything from the Fed in the next few months. I guess that will be more of a question after we get this new Fed chair. So that's one factor. The second factor that we had in US yields was this Greenland thing. You have to bear in mind here, we came pretty close to a pretty much sort of open trade war with Europe. That would have had an outcome where you'd have seen materially more inflation. And again, that would have been a negative outcome for fixed income yields. I also see this narrative around Greenland, if anything, pushing the Europeans to accelerate defense spending, more deficits. Again, that's putting some upward pressure on fixed income rates. But then when it comes to Japan, you raise a really interesting point. I think we've seen as you highlighted, a monumental move in Japanese yields this week. We've really seen the bond market come unhinged after the last 20-year auction. And in my mind, I think that this move was a real overshooting. I think some of the fears around Takaichi's fiscal plans have been exaggerated. And actually, I've got to say, as someone who has had a real disliking for Japanese bonds, having been short for a long time, very publicly short. Actually, this week is a week that will go down in my calendar as the first week that we've actually moved long in JGBs for the first time, I think, this century. I'm not sure since the year 2000 I've actually been long of JGBs, but actually, you look at where 30-year yields are in Japan now, they hit 4%. You look at forward rates in Japan, forward rates at the very long end are above where they were in the US. And so from that perspective, I think there's value to be had in Japanese bonds here, particularly with we've got inflation in Japan actually due in about 10 minutes' time. I'm expecting that to see a nice drop today. So hopefully the conditions there will be turning in our favour.
And I would hazard a guess that you're not the only one feeling that way either. Sherry?
Yeah, and certainly JGB yields, I mean, the moves were so dramatic that it certainly hit unattractive levels for you, Mark. Do you think the market pricing, what the market is pricing now, is not exactly justified? I mean, it feels like the market is pricing in fiscal dominance, but if you really look through the Prime Minister's lines or rhetoric, she did tone down the rhetoric. So, you know, there is some out there that talking about how this dominance theme is not really fair to price in right now. And it's not like she's going to spend like there is no tomorrow. Is that what you're thinking?
Yeah, so Sherry, I think that some perspective is called for here. We should bear in mind, firstly, that if you look at the fiscal deficit in Japan last year, it was just over 2%. Yes, if something is done around the consumption tax, that's going to add to the deficit in the course of the year ahead. But you're still looking at a Japanese fiscal deficit for 2026, I would suggest, which is much lower than pretty much any other developed market that I'm looking at. Look, the US is running a fiscal deficit of 6%. So in terms of order of magnitude, I think it's very different. So I think it would be wrong to get things out of proportion. I think there has been some sort of chatter. We know that sort of Takaichi-san has wanted to think of herself as Japan's answer to the British Prime Minister Margaret Thatcher. And I know that she hasn't taken too kindly to maybe some more recent comparisons to becoming a Prime Minister more like Liz Truss, who famously blew up the bond market in the UK. But I think some of those sort of comparisons are unkind. The Japanese economy is doing well. Debt to GDP as a percentage is going to continue declining this year, partly because growth is strong and inflation is positive. So from that perspective, I think some of the fears in the fiscal side are overdone, particularly when you look at net debt, because Japan is a country with a ton of savings, a ton of domestic savings, and therefore, although gross debt levels are relatively high, net debt is very manageable. And bluntly, there's no need for this bond market to dislocate. ultimately Japanese pension funds only need to earn a 2% return. So I'd almost be asking the question, what are the GPIF doing if they're not stepping in and buying bonds at a 4% yield? This would be a great long-term asset for them to be stepping into right now, I'd suggest.